Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo with Rate. Happy New Year, everyone. This is our first episode of the new year. I know last episode I mentioned about having the episodes on Mondays, but I thought about it over the holiday and I was like, this is really helpful and really beneficial to have ahead of the weekend. So I'm going to stay committed to getting you these updates on Friday mornings. I will have special episodes. So if there's something that I want to delve into more deeply, I'll save that for maybe a Monday episode. But for right now, I want to keep the topical stuff for Fridays because I know if you're a real estate professional or would-be home buyer, your home shopping is mostly happening on the weekend. You're going out to see houses. It'll be really helpful to know exactly where we're at with respect to where mortgage rates are, where the market's going, and that can inform your decisions as you're shopping and as a real estate professional, as you're providing guidance to your clients and the families that you serve. So without further ado, let's get into the current state of affairs with mortgage rates as reported by a Mortgage News Daily survey of the country. We're starting off. 30-year fixed rate mortgages are averaging 7.07%. That's just up a touch from last week, earlier this week, I should say. The 15-year fixed rate mortgage is averaging 6.48%. The 30-year jumbo is averaging 7.3%. The 30-year FHA is averaging 6.4%. And the 7/6 SOFR adjustable rate mortgage is averaging 7%. So mostly everything is up just a touch, with the only exception being the FHA mortgage. That's down just a little bit from where it was earlier this week when I reported out last. The explanation behind the current interest rates this week as we head into the weekend, not much happened. We had the New Year's holiday. There wasn't a ton of data that was released. And quite frankly, in the market, the algorithms run the show. So while the wealth managers and the individuals who would otherwise be doing the active investing, everyone's normally off. So it's left up to the computers that are programmed in a particular fashion, and then they trade in a particular fashion. So what did that translate to for our bond market? Well, the 10-year yielding right now is 4.55%. The 5 years yielding 4.36%. And the 2 years yielding 4.23%. So again, we're still elevated on that 10-year bond. That's indicating that we have the higher rate environment, as we saw from our survey of mortgage interest rates. What's most important today to share is what's going to be coming next week, because there are a few market movers. So that means if you are currently shopping or if you've recently had an accepted offer, it's a good idea to possibly lock in your interest rate, although the trend is moving in a better direction now. We still want to make sure you're protected because there's some things that are going to happen, some data points that are going to be delivered next week that have the propensity and historical evidence of influencing where mortgage rates go. First and foremost, the ADP employment numbers. This is ADP payroll service provider, gives us a report on a monthly basis of jobs added, what the labor market's looking like. That's our first look we're getting in 2025. We also get the job opening survey that lets us know how many jobs are available. We also get the initial jobless claim, which comes out on a weekly basis. And we have the U.S. employment and unemployment rate, which is Friday next week. That'll be reported out the following week, but it is something that is going to have an effect on markets before the weekend. Lastly, we will also get the Federal Open Market Committee meeting minutes. So we had the Federal Open Market Committee that announced that they cut interest rates by 0.25%. Interest rates went up, which has been the story since rates have been cut by the Fed going back to September. And now we're going to actually see what the minutes of that meeting were. That's going to give us some insight as to where the Fed is in their perspective, looking at the markets, looking at the economy, and setting the stage for their monetary policy moving forward. I'll reiterate again what I talked about earlier this week. Set your expectations for not much by way of rate cuts this year. Inflation's rearing its ugly head. Over the past couple of years, since this campaign to manage inflation has continued, it's been the beginning part of the year that inflation ticks up after the retail sales from the holidays and everything like that gets digested into the information and the data that we get. We've seen inflation pick up earlier in the year. So as far as rate cuts are concerned, I'm of the opinion we're not going to see any early in the year. The commentary from the Fed, without looking at the meeting minutes that we're going to get next week, the commentary from Fed Chair Jerome Powell in his prepared statement, as well as his answer to the questions that reporters asked him, all indicated hawkish language. Hawkish and dovish are the two terms that you'll hear and read about when you read news articles that cover the Fed and particular announcements, commentary. Hawkish means they're pretty bold, probably have more of a conservative approach in the context of the current state of affairs. This means the Fed is saying, well, we're not going to be just cutting rates like crazy. We were optimistic in September when we did our first rate cut, did a 0.5% cut, and we saw maybe 3 or more cuts coming in 2025. Well, they said in December at their meeting and afterward that we see 2 cuts now in 2025, and they're going to remain data dependent. Data dependent means if inflation is ticking up, they are not going to cut their benchmark interest rate. Again, my personal opinion, they don't need to. The economy's been doing great. We talked about the GDP, the gross domestic product. That's an indicator of our economic health for the U.S. economy. It's doing great by the numbers. Now, how it feels as a consumer in America, that's a different thing. That dissonance is continuing to cause struggle. But if we're just looking at the things that the Fed will look at and that people who invest in the markets look at, the economy's doing well. And there's been appreciation in the economy, a ton of growth. Now, some people say that it means a correction's on its way. Time will tell. For right now, for our purposes, looking at mortgage rates, expect what we have and possibly maybe a little bit higher if inflation continues, with maybe some opportunity of a little bit of relief, but the relief will happen in steps. And luckily, that will be the case. I am of the opinion that interest rates dropping like a stone at any point is going to cause shock. It's going to cause shock to the banking system because we talk about mortgage rates. That's how much you pay for the money that you're borrowing. However, mortgage rates and the lending environment also influences yield rates. When I'm talking about yield rates, we're talking about those savings accounts that you have at your bank or online banks where you're getting, 4.5%, 5% for a time, and now that's been reduced down. As the interest rates go down, so do those yields. Now, if rates drop very quickly, that causes shock to the banking sector. That's not good either. So I see a world where in 2025, it's going to continue to be volatile. Unfortunately, my Christmas wish wasn't fulfilled. I just didn't want volatility for the year ahead, but we're going to have a volatile year. And it'd be one thing if we're not used to this by now, but we are. We had all of 2024, which was pretty much going to be, in my opinion, where we're going to be going in 2025. So there's going to be volatility. Interest rates will probably step down little by little with some moments where they're going to go up. I don't know that we've reached the peak of 2025 at this point. It's way too early call 2 days into the year. But I think that we're kind of close unless we get some inflation data that's really bad, where we see inflation really tick up. That can then change the script, change the narrative in a big way. So I'm excited to share what those Federal Open Market Committee meetings reflect next week on next week's episode dropping on Friday. For my Did You Know section today, I wanted to talk about the Millennial and Gen Z housing trends. If they're not living at home, they're renting. And there's a couple of reasons why. And this may be something that's not foreign to you as the listener, to people that you know in your network, in your family even. But I wanted to just visit a couple of the things that are impacting Millennial and Gen Z buyers, which would otherwise be the prime market for home buyers right now, and the difficulties that they are currently experiencing. So first and foremost, it's the increased affordability that hasn't really happened. We are seeing that home prices are continuing to appreciate. What we talked about on Monday, real estate values are continuing to go up. Even with the volatile rate environment, they're still going up, and it's a function of the supply and demand. And now I'm going to talk more exclusively to New Jersey and the New York metro area. This is applicable, but I'm going to keep it to hyperlocal here in New Jersey, where I do business, where I assist families get pre-approved and buy homes day in, day out. inventory is tight, and it continues to be tight. I've seen a little bit of an uptick as soon as the calendar flipped to the new year. A couple properties were put on the market locally in my area here in North Jersey. I'm situated in Totowa, which is near Wayne, Patterson, Woodland Park, Little Falls, the Tri-Borough, Passaic County, Bergen, and it's in that thin part of Passaic County, so borders a number of Essex, Bergen, Morris, Sussex. We're kind of in the mix here. So in this North Jersey market, inventory's tight, particularly near commuter towns. It continues to be super competitive. So the affordability is a challenge, first and foremost. It's not for lack of wanting. So the Millennial and Gen Zers, the ones that I work with very regularly, they want to buy a house. It's just a matter of meeting the goal of monthly payment with what they have budgeted for, because these prices have appreciated so much. The only ways to really navigate that, one, more down payment so you're borrowing less money, and that's a challenge. Well, all prices have gone up so much over the past 3 to 4 years since the pandemic, with inflation being what it was. So it kind of creates this vicious cycle. The other is there's been some changes in taste. So urban living has been more of a preference for these generations. And in more urban environments, it's more common to rent. It's when they start having families that they want to move out. But then when they move out, they've got another mouth to feed or another mouth to feed on the way. And then they've got more expenses to shoulder with a new home and everything that comes with a new home. So if there's things that go wrong in the house, you need to make sure you got your rainy day fund so that if the boiler goes or, something that's unexpected, that's an unexpected expense, which happens when you own a house, that is something that needs to be considered. And that's one of the things that kind of prevents would-be home buyers in these two generations from taking that next step. Technology and accessibility is another element to this. When you are able to shop online for places to rent, virtual tours are super sharp. Online application processes, as much as I do my very best and I am proud of everything that we've done here at Rate and what we're able to continue to accomplish moving forward and everything we have planned for 2025 to increase the efficiency of the mortgage process, including the pre-approval and the approval process for our clients. As much as we've done a lot there and we can do it very quickly, it doesn't compare to the fact that when you complete a rental application online, it could take you 15 minutes. Your rental application's in, you can get automated notification that your rental application's been accepted and now you can sign off on a new lease. So these technological advancements and accessibility does make it a bit easier and more appealing, especially when you have consideration of down payment, consideration of responsibility for the property. That are things that are somewhat fear-based, that are part of the psychology of these two generations, the Gen Z and the Millennials. The economic realities are also, like we just talked about, home prices continue to appreciate. We still are seeing interest rates move higher, even by a small margin. When we just looked at what happened this week, interest rates are high. It makes affordability more challenging. The only possible sign of relief that could be considered in this is if we have exposure to this market for long enough, where we have the higher rate environment for a longer period of time into 2025. I do have a theory that longer term exposure in a higher rate environment will eventually affect home prices regardless of the inventory status. So I think that one of the silver linings to having higher rates that we do have right now, and I know this is tough to swallow, but one of the realities is if we keep this higher rate environment, maybe we will start to see not necessarily a compression on home values, but just not the same growth rate of appreciation. When we look at the National Association of Realtors every month, we're doing a comparison month over month, year over year. And those are showing us how much the home prices have appreciated over the 12-month period and the 1-month period. If that just starts to slow down a little bit, that can create more affordability. And it's going to be incremental progress in that scenario, but that is a silver lining to consider. The last point I wanted to mention was kind of a thought exercise, because I've talked about this on past episodes, but as we are now coming to understand, the mortgage rates are going to be a little bit more volatile going into 2025. It's really important to know what that effect is going to look like by dollars and cents. So let's talk about this. 1% change, let's say mortgage rates go up 1%. That 1% change in the mortgage rate affects 10% of buying power for would-be home buyers. So I'll say that again. A 1% increase in mortgage rate reduces a buyer's buying power by 10%. What does that look like by the numbers? Well, we're averaging around 7% right now for the 30-year fixed rate mortgage. If we wanted to find a time that mortgage rates were closer to 6%, 1% less, we're looking at January 2024, when we started last year, around this time last year. There was an overwhelming optimism about inflation coming down and the Fed cutting rates like crazy in 2024, which the first one didn't happen until September. But all we needed was that expectation, and it created the reality in the market, and we saw lower interest rates. So if we go back now to that time, you wanted to buy a $550,000 house here in North Jersey, with rates at 6% then, compared to now at 7%, your buying power is now $495,000. So over $50,000 of buying power disappeared because of that 1% increase. And that's a long timeline, right? Now, here's what we just looked at, averaging in North Jersey anywhere between 5 and 7% property appreciation. So now you can see 1 year later, you lost 10% of buying power based on the interest rate, and also the goal lines got pushed out another 7%, possibly 5 to 7%. So that compounding effect has made it really challenging, and that's why this affordability challenge continues to persist in the market. Now let's look at a more recent timeline. So if the math works like that, 1% change, 10% reduction in buying power, let's look more recently. When rates were averaging around 6.5% ahead of the Fed rate cut in September, that was the best rate environment that we've had recently. And then ever since the Fed rate cuts happened, we saw interest rates go up. So let's look at that timeline. So let's say you were shopping around September, early September, mid-September. Interest rates were averaging, we reported out at that time, in the 6.5% range for a 30-year fixed rate mortgage. Now, closer to 7%, if your max budget buying power was $550 when your interest rate was 6.5%, now your max buying power is reflecting something closer to $522,500. So a little more than $25,000 less in buying power just in the 3 months, 4 months almost now, since that rate environment changed. So that's why this is going to be very important weekly to stay on top of where mortgage rates are. If you are pre-approved right now, continue engaging with your mortgage professional to stay on top of where interest rates are. Make sure that does not negatively impact your pre-approval. I welcome you to reach out to me if you have any specific questions about your pre-approval. My email address is peter.d'angelo@rate.com. It's in the episode description below. That is it for me today. I hope you found this helpful and useful to kick off your new year. Before I go, just wanted to give a big shout out to my mom. It is her birthday today, Kathy D'Angelo. So happy birthday, Mom. I hope you're having a wonderful day. For those of you who are going out this weekend to look at homes, best of luck. Feel free to reach out to me on socials or reach out to me via email. If there's anything you'd like me to cover in detail or expand upon that I've already touched upon this episode or past episodes, I encourage you to reach out. Otherwise, I look forward to seeing you all next week with your latest and greatest update on mortgage rates and what's going on in the real estate world. Take good care.